Welcome to Market Brief After Hours. Today we are looking at a market that seems to be losing its momentum. Investors are juggling a really mixed bag of economic signals, and there is renewed pressure coming from rising oil prices. We've got a lot of ground to cover, from a noticeable divergence in US PMI data to a slip on Wall Street, plus some major moves in Forex and individual stocks. Let's start right at the top with Wall Street. How did the major indices hold up today?
It was definitely a day of cautious retreat. The optimism we saw in the prior session just faded away. Looking at the numbers, the Dow Jones Industrial Average slipped by 0.18%, topping about 84 points to close at 46,124. The S&P 500 gave back some of Monday's relief rally, declining 0.37% to close at 6,556. And the Nasdaq Composite took the hardest hit, falling 0.84% to finish at 21,762.
That's a noticeable underperformance from the Nasdaq. What was dragging it down so heavily compared to the rest?
It comes down to a resurgence of tech weakness. Growth and technology stocks came under renewed pressure today because of two main factors: rising Treasury yields and persistent geopolitical risks. When yields go up, high valuation sectors like tech become less attractive. Meanwhile, the S&P 500 had a very split personality today. The overall index was down, but energy stocks actually surged. The energy sector rose 2% on the day, extending its month-to-date gains to over 9%. In fact, energy is the only sector sitting in positive territory this month, and that is entirely driven by the sharp rebound in oil prices.
Let's dig into that oil rebound, because it seems to be the dark cloud hanging over the broader market outlook right now. What exactly is driving this surge? And speaking of inflation fears, we had some mixed U.S. economic data today that probably didn't help settle any nerves.
Exactly. The US PMI data showed a real divergence. On the positive side, manufacturing activity surprised to the upside. The manufacturing PMI rose to 52.4 in March, beating expectations with solid improvements in production and new orders. But on the flip side, the services sector is slowing down. Services PMI fell to 51.1, which is the slowest expansion we've seen in 11 months. When you pair that with productivity data showing Q4 growth revised down to 1.8% and full year 2025 slowing to 2.1%, it paints a picture of uneven growth and a broader deceleration in economic efficiency.
That definitely explains the rising Treasury yields you mentioned earlier.
Yes, the bond market reacted strongly today. The two-year Treasury yield jumped over 9 basis points to 3.925%. That followed a very weak $69 billion auction, where the bid-to-cover ratio was just 2.44, the lowest since May 2024. The 10-year yield also climbed more than 5 basis points to 4.392%, and the 30-year yield rose to 4.956%. Markets are aggressively pricing in persistent inflation risks driven by those higher oil prices.
Let's shift our focus overseas. How did the European markets digest all these global headwinds?
European markets actually managed to close higher, reversing earlier losses, despite some pretty weak regional data. The Pan-European Stoxx 600 rose nearly 0.5%. In the UK, the FTSE 100 gained 0.60% to close at 9,954. Over in France, the CAC 40 added 0.2% to 7,741, and Italy's FTSE MIB rose 0.4% to 43,363. Germany was the outlier among the majors, with the DAX slipping 0.23% to 22,602. The gains we did see were mostly led by oil and gas, telecoms, and chemicals.
You mentioned weak regional data in Europe. How bad were the numbers?
Pretty concerning, honestly. The Eurozone Services PMI fell to 50.1, and the Composite PMI dropped to 50.5, which essentially signals that growth is stalling. Germany's Services PMI fell to 51.2, and France slipped even deeper into contraction territory at 48.3. But the most alarming data came from the UK. While manufacturing PMI edged down slightly to 51.4, UK retail sales absolutely collapsed to -52. That is the weakest reading since April 2020, right at the start of the pandemic. It highlights massive pressure on consumer demand. We also saw Bellway shares plunge 17.5% after they warned about volatility in the mortgage market.
What about the Asia-Pacific region? Did they fare any better?
They did, mostly advancing, though some gains were pared back as those energy prices rebounded.
South Korea's Kospi had a great day, closing 2.7% higher at 5,554. The Hong Kong Hang Seng Index jumped 2.39%. In Japan, the Nikkei 225 rose 1.43% to 52,252. Japan was actually supported by data showing headline inflation eased to 1.3% in February, the lowest level since early 2022, thanks to stabilizing food prices and fuel subsidies. India also had a strong showing, with the Sensex and Nifty 50 both climbing over 1.7%. However, New Zealand's market fell 1.5% to an 8-month low, because their central bank governor warned that interest rate hikes might be necessary if this oil-driven inflation persists. Australia's ASX 200 just managed to squeeze out a slight gain of 0.16%.
We are going to take a quick break, but when we come back, we will dive into today's massive Forex movements, the technical levels you need to watch, and the individual stocks making the biggest waves today. Stay tuned. Welcome back to Market Brief After Hours. Before the break, we covered the macro landscape and global equities. Now let's get into the currency markets. It sounds like the US dollar was flexing its muscles today against the major pairs. What is happening with the euro?
The euro is under significant pressure. Euro USD extended its decline today, closing at 1.1586, down 0.23%. It traded in a range between 1.1617 and 1.1557. What's really critical here from a technical standpoint is the moving averages. The pair has now broken firmly beneath its 50-day simple moving average, or SMA, at 1.1727. It also broke the 100-day SMA at 1.1687 and the 200-day SMA at 1.1676. Breaking below all three of those key moving averages reinforces a very bearish shift in short-term momentum. We are seeing a sequence of lower highs and lower lows since the late February peak. Immediate resistance is now at 1.1617, and if it breaks below the 1.1557 support, we could see it test the 1.1500 psychological level.
And the British pound? Did it suffer a similar fate?
It did. GBP USD slipped further, closing down 0.33% at 1.3382. It hit a session high of 1.3445, but faced continued selling pressure, dropping to a low of 1.3352. Just like the euro, the pound has moved below its major support levels. It's currently trading below the 50-day SMA at 1.3506, the 100-day SMA at 1.3404, and the 200-day SMA at 1.3434. This indicates a real deterioration in the trend structure, forming lower highs since mid-February. If it fails to hold above the 1.3352 support, we could see downside momentum accelerate toward 1.3280.
What about the Australian dollar?
AUD USD fell sharply today, closing at 0.6967, which is a drop of 0.60%. It ended the session right near its daily lows. The big technical signal here was the break below the 50-day SMA at 0.7000, highlighting a loss of short-term bullish momentum. However, unlike the euro and the pound, the Aussie dollar is still holding above its 100-day SMA at 0.6798 and its 200-day SMA at 0.6667. The broader uptrend from late 2025 remains intact, but it's clearly in a corrective phase right now from its recent highs near 0.7200.
Let's pivot to precious metals. With all this geopolitical tension, how did gold and silver perform?
Gold had a bit of a volatile session, but managed to stabilize near long-term support following a recent sharp correction. It closed at $4,401, down just 0.14%. It traded in a wide range between $4,485 and $4,306. Interestingly, there was a long lower wick on the daily chart, which indicates strong buying interest when the price dipped to those lower levels. Technically, gold is below its 50-day SMA at $4,960 and its 100-day SMA at $4,590, so the short-term phase is bearish. But it continues to hold above that crucial 200-day SMA at $4,077.
And silver?
Silver actually rebounded today. It closed at $69.47, up 0.54%. It dropped to $66.01 at one point, but saw a very strong recovery from those session lows, peaking at $70.40. Like gold, it is below its 50-day SMA at $85.86 and its 100-day SMA at $73.01, but it is successfully defending the 200-day SMA at $57.01. That sharp rejection of lower prices today suggests that buyers are stepping back in, keeping the broader bullish structure intact.
Let's finish up with the crypto space and some individual market movers. Bitcoin has been on quite a ride recently. What happened today?
It was a day of whiplash for Bitcoin. It briefly climbed as high as 71,382 earlier in the session, but then reversed sharply to close at 69,400, down more than 2%. This dragged its market cap back below the $1.4 trillion mark. The drop was a direct result of that sudden shift in risk appetite caused by those conflicting reports on US-Iran negotiations. Crypto-linked equities felt the pain too. Coinbase fell more than 10%, and Mara Holdings dropped over 6%.
Moving to traditional equities, what were the biggest stock-specific stories today?
We had some massive moves today. Circle shares plunged more than 20%. This happened after their rival, Tether, announced it had engaged a Big Four accounting firm to audit its USDT reserves. Investors are clearly worried about the competitive pressure that brings. Then we had Estée Lauder, which dropped nearly 10%. Reports emerged that they are nearing a deal to acquire Puig brands, and investors seem highly skeptical of the move, adding to the stock's declines from the previous session.
Any major downgrades or upgrades moving the needle?
Yes, SAP slid 4% today. JP Morgan downgraded the stock to neutral and cut its price target. The analyst cited slowing cloud backlog growth and limited visibility for when that might re-accelerate. On the positive side, Applied Optoelectronics surged a massive 18%. They secured a new order for 800G transceivers from a hyperscale customer. That rising tide lifted other peers in the space too, with Corning and Lumentum both jumping around 9%. Finally, Netgear rallied 10% after the Federal Communications Commission banned imports of foreign-raid consumer routers due to national security risks, essentially clearing the competitive field for them.
It sounds like we are entering a highly reactive phase in the markets, where short-term direction is being dictated by shifting policy expectations, inflation pressures, and geopolitical headlines. We will be right here to track it all as it develops. If you find this useful, please follow Market Brief after hours.